Hello, Keith Prather here with your August NCM Automotive Economic Update. I'm going to go ahead and share my screen. So this month's automotive demand index came in at 58.3. So it was down just a little bit from the 59.9 that we posted last month. But on a historical basis, it still remained, well above. Well, it's right at the trend line, but well above prior periods. Like if we think of the 2014 to 2016 period, we're still higher than that. We're also higher than actually, just the pre-pandemic period in 2019, and then obviously we had the recession caused by the pandemic. But on a historical basis, we're sitting kind of in an average range, something that we were used to in that decade prior to the pandemic. Now, I know there's a lot of sluggishness out there, and the index was 2.7% lower month over month and was also 1.2% lower year over year. So there is still some sluggishness out there, but a lot of dealerships will tell you, and they've told me, that there's still pockets of sales and they still see some robust activity in some categories. And so that will continue. And I think overall, the economic outlook will get a little bit better as we go into 2025, and we'll talk about that here in a moment. A lot of it will be based on what the Federal Reserve does. And I know this is an ugly chart, but this is the Federal Reserve's dot plot. And so each one of these blue dots represent a vote or basically a forecast by one of the Fed members of the board. And so what you'll see is in the June meeting, when they last issued the dot plot, the average vote would have suggested that rates would have been somewhere around 5% at the end of 2024. With the new dot plot, though, the Fed is much more aggressive, and we see the average estimate now somewhere down around 4.5 to 4.75% by the end of the year. So that would suggest that after that 50 basis point cut that we got in September, that the Fed may follow that up with at least another quarter point cut in rates, perhaps even 2 quarter point cuts. We'll see what happens. A lot of the economic data that's coming in right now is a little bit hot, so that could make the Fed pause after this initial cut. A lot of it may depend on the election as well, but we'll see what happens, as we get into November. But interestingly enough, many of them were unified in the fact that rates are going to be a lot lower by the end of next year. And so based on the prior forecast, the rates will be somewhere around 4%. Now we're looking at somewhere around 3.25%. So that would suggest maybe another, at least a full point cut in 2025, maybe a point and a quarter. The bottom line is that it's going to become a little bit easier lending environment, and consumers should be chasing that lending environment overall, which just going to create a better environment for automotive in general. The other piece that we're watching real closely, and I've talked about this in prior months, is what happens with disposable income. So real disposable personal income is just inflation adjusted income that's left over after we pay all the basics. So we pay taxes, food, shelter, some of those. What's left over to be able to go make a big ticket purchase and be able to take on additional debt in the course of a month. And last month, if you remember right, if you watch this, we were seeing a trend of about 1.1% through 2024. And what happened is the Federal Reserve went in and they got more accurate data, and they've adjusted what they believe the current income, personal income is in the United States, and it's coming in at about 3%, which is a little bit hotter than expected. So we think for 2024, the prior forecast was 1.4%. We think we're going to get somewhere around maybe 2 to 2.5% for this income growth rate. So that's still weaker than 2023. So if you're feeling that year over year slight dip in auto sales volume, it's true. Income is tighter, especially inflation adjusted income is tighter, and that squeezes households and it makes it tougher for them to go out and purchase. But it's better than expected. And so coming out of the overhang of the election and the East Coast port strike and some of the uncertainty that's kind of gotten consumer sentiment depressed over the last couple months, we may see coming out of this period that incomes are better, consumers will realize that inflation is still cooling, and they may begin to get out and move about and start to spend money again. That's the hope. So our forecast right now for automotive production, so this is the production side of things, but this forecast is based a lot on demand dynamics, right? It's based on demand for automotives moving forward. So it takes into account inventory levels, it takes into account consumer spending, pressures on consumers, all those factors that shape automotive sales. And right now it's showing a fairly flat environment over the next 18 months. We have a little bit of softening in the back half of next year, but then it kind of pops back up at the tail end of that period. If you look at it though on a historical basis, that's what's most important here. What's most important is that if you look at it historically, we are still expecting a fairly solid automotive environment, right? This is nothing that looks like a recessionary period for automotive. It's nothing that looks like a major, depressed environment for automotive. It looks like it's going to continue to be stable. Now, that doesn't mean all sectors and all pockets are going to be stable. As you'll see if you read the report, we're calling out certain sectors based on household spending at levels. So those cars and those vehicles that are tailored to middle and upper income households are going to continue to do very well. So some of the higher end hybrids, fully loaded trucks, you take a look at the higher end SUVs. A lot of those categories of vehicles are going to continue to see strong demand, and probably you're going to have a difficult time keeping inventories in place to be able to meet that demand. That looks like that's going to continue through 2025. We're concerned about the bottom half of that income spectrum. So lower middle incomes and lower incomes, that would typically be some of the entry level vehicles, maybe economy class cars. That level is still going to continue to be sluggish, and that's what we're concerned about. And that's kind of what this is reflecting. So it's reflecting demand out there, but the bottom line is you may have to chase it a little bit more to go find it. And I think that's where we're headed for next year. So in summary, we don't see anything in the economic forecast at a macro GDP level that suggests that we have any kind of recessionary risk ahead for the moment. Now, there are things that could blow that up. We could have a big issue in the Middle East. We could have something erupt in Asia. We could have all kinds of other factors. We could have another port strike starting in January. There are a lot of factors and a lot of things that we're going to be watching over the next several months. But right now, based on the economic fundamentals and how the economy is actually performing, there's not a lot of near-term risk out there. So we see Q3 coming in a little bit hotter than expected with 3% growth. We see Q4, we think Q4 could be as high as 2%. So still a good economic environment overall, not a lot to be depressed about. So that's kind of your rough summary for the August-September period. And we're going to go ahead and stay with this, and we'll bring you another update next month, and hopefully we'll get a little cleaner data after the port strike and after what happened with the hurricanes. But until then, if you have any questions, please reach out to me. My contact information should be available, and we'll look forward to talking to you next month. All right, take care. Stay safe, everybody.